Hello everyone. I will cover fixed income market for the month of September. Let's start with growth first. In India, GDP growth moderated to 6.7% in second quarter of 2024 from 7.8% in the previous quarter. This was mainly due to weaker government spending. This growth number has undershot the RBI's estimate of 7.1% by around 40 basis points. High frequency data for the current quarter is indicating a mixed picture. Urban consumption, industrial growth has weakened, revenue expenditure by government has moved lower, while rural growth and capex, public capex, are improving. Going ahead, moderation in credit growth is likely to be a drag on growth. In US, weakness in labor market is evident. Non-farm payroll additions have started to slow. If one digs deeper, other labor market indicators such as hiring rate, unemployment rate, all are around levels where past recessions began, bearing a lagging indicator of wage growth, which is still strong. Globally, manufacturing PMI are back into contraction. The uptrend in China exports, which is an indicator of global trade, is now flattening out. Continuation in Europe retail sales recovery remains doubtful. In India, headline inflation in month of July 2024 dropped to 3.5%, largely owing to a high base effect. Food inflation fell to 5.4% versus 9.3%. Core inflation has edged up to 3.4% from around 3.1%. As the base effect wanes off, we could see core trending back to 4% plus as we move towards FY25. This would mean it is now critical that food inflation has to come down so the headline inflation overall remains at the RBI's target of 4%. Globally, disinflation is unfolding at a fairly steady pace. In US, on a 6 months analyzed basis, headline CPI inflation has dropped from 2.8% in June to 2.5% in July. This decline appears to be broad-based. That may result in further softening going ahead. In line with these growth inflation expectations in India, the sovereign curve has witnessed 5 to 10 basis point rally across the curve. Global rates too have moved lower during the month, tracking softer US data, primarily with NFP data that missed even the conservative estimates in US. In line with this, the markets are pricing in first rate cut by Fed in 4 years in upcoming September FOMC policy. In India, policymakers have been focusing on macroeconomic and financial stability and a favorable growth inflation balance. In addition to this, any weakness in high frequency data domestically or even expectation of sharper policy recalibration in US has not moved central bank's view, which is still having hawkish guidance for food inflation risk, along with steady growth expectations. This has in turn meant that in India, 10-year benchmark GSEC rates have not moved downward sharply in line with the recent global cues, even with the support of very healthy FPI inflows. Otherwise, the reasons for supporting the rate cuts are stacking up, such as concerns of hard landing in US economy, record low core inflation, expected fall in food prices post-monsoon, and high real rates possibly restricting growth, which are all indicating change in policy stance soon. However, in coming quarters, as slacking growth becomes more visible, we expect policy priority to shift from restraining inflation to supporting growth. In line with this view, our recommendations largely remain same. We recommend investors with a holding period of at least 1 year to consider investing in longer duration funds. The 10-year to 15-year segment and long end of the curve stands to gain from any possible rate cuts in future. For investors with lesser appetite for duration risk can consider funds like banking PSU fund with a moderate duration of 3 to 5 years. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.